Well, thank you very much, Avin, for this invitation and for the opportunity to discuss with domestic and international investors about our macroeconomic outlook and the opportunities for the future. I have prepared a presentation for everybody. So I guess I'm gonna make use of the possibilities to show it in the screen, if that's okay.
Sure, please do. Thank you.
Okay. Okay, just please confirm me if you're seeing it.
Yes, we've got it up now. Thank you.
Okay, so we have something like 30 minutes for the presentation?
Correct, that's correct, yeah.
All right. That is good. So once again, thank you very much for the invitation to Bonds and Loans. And I have prepared a presentation that has two main parts. The first one has to do with something that is very important, especially during turbulent times like the ones that we're experiencing right now. And is the long-standing features of the Colombian economy that provide certainty about macroeconomic stability. And in the second part, I think this is a great opportunity to start discussing what we see as areas of opportunities for investment and reactivation once the COVID emergency abates. So let's go to the first part. In what we have called, Colombia has three anchors for macroeconomic stability. When you're an investor, you will always see that Colombia, it may not be the fastest growing economy in Latin America in emerging markets, but it's definitely top 2 or top 3 in the most resilient economies in the region and among rating peers. And this chart on the left, when you look at the blue line, you will see that Colombia starts this emergency with a very favorable position against Colombia and against its regional peers. Colombia was definitely the fastest growing economy in among investment grades in Latin America in 2019, as is shown in the blue lines. But I think most interestingly, in addition to starting in a favorable initial position, is the fact that even when we start collecting the data for growth in the first quarter of 2020, you will see that Colombia not only is the country that, one of the two that is growing in positive territory with Chile, but also it is the economy among investment grade sovereigns in Latin America with the highest rate of growth, 1.1%, even after factoring in 2 weeks of a very strict lockdown. On the right is probably a chart that you have seen before, but here is to strengthen the point about resilience. Over the last 40 years, Colombia has only had 1 year of negative growth. And this 1 year of negative growth was in 1999, in the middle of a very deep financial crisis in the country. But when you do this same indicator for all the other economies in Latin America there, you will see that countries like Chile, like Brazil, Mexico, have had between 4 and 7 years of negative contractions in Latin America. So it's again a show of resilience. It's unfortunate that we will have to update this chart with a second year probably of economic construction in 2020. But I think that the message is clear in the sense that we're not only dynamic, but we're also resilient. This is very interesting. When you dig deeper in the first quarter information for Colombia, and you see the heat map on the left, you will see that all the major activities of GDP continue to grow in green even during the first quarter of 2020. Activities like retail and transportation, public administration, real estate, agriculture are still in green, and you will see that they are the ones that have a highest share in our GDP. You also have activities that are important, like construction, mining, that are growing negatively, but as you will see, their share of GDP is much lower. So again, if we divide the GDP by supply in 12 sectors, we will see that 8 of those 12 sectors continue to grow positively, even during the first quarter of 2020. But we have to recognize, and that is the chart on the right-hand side, that what we started reporting as a very successful investment-led recovery in Colombia, and investment is this gray line, that gray bar that you have on the right, is a stop. So the first casualty of this pandemic emergency was really a stagnation of investment-related activities that somehow has been offset by very robust private consumption and government programs. The positive news is that although Colombia was one of the most strict countries at the beginning of the pandemic, by starting to impose lockdowns since mid-March or end March, it is also being the country that has been more, let's say, dynamic in the reopening of the economy. On the left-hand side there, you will see that even during the most strict lockdown, the production capacity, and production capacity is different to economic growth, is how much of our installed capacity was functioning, and even during the most stringent part of the lockdown, we were operating at 70% capacity. That capacity has been gradually increasing. In the month of April, it went up to 77%. In the month of May, it was reaching 90%. And we have a target that in the second half of the year, this production capacity that I insist is different to economic growth. It's just the installed capacity that we have will move closer to 100% in the second half of this year. And we are seeing this in one of our favorite indicators, because it's really real time, which is energy demand. And you see there in that blue line on the right that during January and February, energy demand was very similar to the levels of activity that we had a year ago. The economy was performing well. And when the lockdown was established, you will see how this energy demand really plummeted to a contraction of minus 34% year on year. And once these measures started to ease, it really had a V-shaped recovery, let's put it this way, when it went from growing negatively 34% to actually growing at 8% in the middle of May, and today that rate of growth is closer to 6%. So the economy is gradually reopening, and a final feature of why the Colombian economy is, let's put it, more resilient than similarly rated peers in the region and abroad, is the fact that Colombia is one of the few emerging markets that actually has a truly and fully flexible exchange rate regime that facilitate orderly adjustments and smooth out the impact of economic cycles on real activity. And this is the chart on the left. The chart on the left is a very classical macroeconomic book adjustment in which we started with a deficit, a current account deficit of $3.5 billion, the equivalent of 4.1% of GDP, and how just in one quarter, we moved down to a current account deficit of $700 million less. And this happened to what you would expect. First of all, a significant contraction of profit repatriation. Multinationals operating in Colombia cut their profit remittance by 33% year on year. And this is acting as an automatic stabilizer for the current account, if you want. Another interesting thing is that the reduction of imports started to operate also as an automatic stabilizer. The deceleration of domestic demand is narrowing the trade deficit. But nonetheless, in issues like transfers and services, which are very tied to tourism and remittances from workers abroad, still contribute negatively to the current account. But you will see how, by the virtue of this foreign exchange floating regime that we have, flexibility, it's easier than for other economies, the adjustment process. And this chart on the right is very telling about Colombia. Because as I mentioned, when I was an analyst, I did the same type of analysis for other countries like Argentina, and then you have different recessions to assess. In the case of Colombia, you only have one recession in the last 40 years, and it's the 1999 recession. And you will see how it went through a process of a very V-shaped downfall and recovery. So it took us really 4 quarters to bottom down in the trough of the contraction, and then it took us again something like 4 quarters to get back to a similar rate of growth or even higher than we started before. Another important test was the red line. In the global financial crisis, what we have was what economists call an L-shaped recovery. So it took us a lot. We went down in the global financial crisis in 2009 in a matter of 4 quarters, but see how the path for recovery was very flat in the first 3 quarters. And it was only in the last 4th quarter that the economy started to pick up. But the good thing is that the economy was never in recession. It actually took 0% in the throes of the crisis at that point. And the other 2 lines are very informative because the other 2 lines are not recessions or significant contractions, but are downswings in the oil sector. So both in 2002 and in 2017, commodity prices corrected significantly, and you will see how this mechanism of the flexible exchange rate regime actually helps to have a shallower contraction and an orderly recovery, which are the purple and the green line. So I hope to have illustrated what we call in Colombia as a very dynamic economy that is also very resilient to absorb both domestic and international shocks. The second important anchor for macroeconomic stability is that we have had a very prudent response to the emergency. And when we say prudent, is the fact that both in the size of the response package and the composition at this response package, we have been very careful in striking a very delicate balance between being bold enough to support our vulnerable sectors, but being prudent enough to not jeopardizing our macroeconomic and fiscal stability. So the package has three pillars. What you would call fiscal cash disbursements is something in the order of 3 points of GDP. And that is divided sort of in thirds, a third for the health sector, a third for vulnerable populations, elderly, young, informal, low income, and another third for what we have called employment protection programs that we have. We have another 3% of GDP that is more in the form of liquidity provisions. And I insist, this is not actual disbursements of cash from the central government. This is more in the hands of the central bank. And they do this liquidity provision to the system through three main mechanisms. The first one is repo facilities that have been upsized and make more flexible for beneficiaries. Bond purchases, both of private debt and government debt, and the relaxation, the cut of reserve requirements by 3 percentage points. And finally, we have another mechanism that is the credit guarantees. And credit guarantees is something between 4.5% of GDP to 5% of GDP. And although it doesn't involve necessarily an upfront disbursement of cash, what the government here is trying to do, and this is similar to my friend Patricio, who was talking to you about Chile and Peru and other countries, is the fact that once you have the fiscal response and once you have the liquidity provision, liquidity doesn't necessarily mean an expansion of credit. And the fact is that the financial sector and investors are having this harder time to have risk appetite for this credit. And therefore, we have designed a system of credit guarantees through our fund for government guarantees in schemes in which we can actually guarantee between 60 to 80% of the loans that can be provided by the private and public financial system, especially to SMEs, to independent workers, and so on and so forth. So this has created a situation in which our financing needs are increasing. The first derivative is this 3% of GDP increase in spending. But the second derivative is something that is more difficult to estimate, but is also important. And is the fact that we know we're gonna have a negative surprise on tax collection. So this combination of 3 points of GDP that you need to spend more on your government programs to serve the emergency, and this potential shortfall that you're gonna have in tax revenues due to the contraction in economic activity is what is increasing our financing needs by a significant amount. So how are we funding this increase in financing needs? We have been followers in Colombia of the principle of diversification. As you see in the left-hand side, we have used all of our financing activities, and we have been very careful in actually not crowding out investment in our bonds, in our debt instruments. So from that increase in the financing needs, we have two good news. The first one is that we have pre-funded most. And the second one is that we have used this mix of sources that you see there. 36% approximately in domestic bonds, 20% with multilaterals. We have been very, very active with them. not only because we can benefit from lower borrowing costs, but also because we can extend significantly the tenors at which we access financing. We have also used international bonds, which we are going to discuss later on. We have taken advantage of public sector savings that were accumulated for the rainy days in funds like our oil stabilization fund and our regional pension fund. And we have also been benefited with the imposition of a solidarity bond contribution. So after the central bank lowered reserve requirements and free up close to 1% of GDP in resources, these resources were invested by the commercial banks in government paper at a tenor of 10 years. So we try to approach this increase in financing needs through a diverse mix. And the results have been very encouraging. Approximately 1 month ago, we tapped international capital markets, and we were able, this chart on the right show you that we overweighted our bid for longer tenors. So we really wanted to maximize our average life of our borrowing in external markets. So 55% of the $2.5 billion that we access were at the tenor of 31 years. But more importantly, thanks to being very tactical and our financing strategy, we were able to secure the lowest ever coupon on a 31 year. And you see there that we have the main benchmarks that we have issued at 30 years since 2006 to 2020. And you see by component, the dark blue being treasuries and the gray being spreads, how we really move from the neighborhood of 7.5 or 6% a few years ago to a record low coupon of 4.2% 1 month ago. And the positive response by the markets have also been reflected in our domestic assets. On the left-hand side, we have the Colombian peso compared to other peers in the region. And you really see how, if we index at January 1st, you see how we were all having a very stable ride the first quarter of the year. And suddenly when the pandemic and the commodity prices hit, everybody sold off. Everybody sold off, but Colombia was one of the most punished currencies at the time. But you will see how, starting at the end of March, and Colombia is this dotted red line, you see how Colombia started to easily outperform Brazil, easily outperform Mexico, and even in the latest part of this cycle, it was outperforming Uruguay and actually approaching the territory or the performance of currencies like the CLP and the pen. So this is what we have called normalization. Granted, the levels has not returned in terms of currencies to the pre-COVID levels, but we're very close to there. We're very close to really recovering all the activity to that era. And on the right-hand side, what you see is our local currency curve, what we call COLTES. And you see a similar story. Back there in January, our yield curve was the gray line that you have there, a very flat yield curve. In the midst of the pandemic and the lockdowns, our yield curve shifted upwards significantly. But today, and this chart is mid-June, our yield curve has significantly come back to the levels pre-pandemic. And there has been an interesting phenomenon of steepening. And I think that the main point of news there is the fact that Colombia had the central bank that actually came at the last moment in delivering interest rate cuts. And that is what is probably reflecting this significant shifting downwards of our yield curve in the short part of the curve. Now, the negative news is that as many other emerging markets and actually developed markets, this pandemic and this rapid and significant expansion of packages to attend and mitigate the impact of the sanitary emergency is going to leave a significant footprint in the debt burden. We were very successful in actually stabilizing our debt burden last year, when it pretty much was stable between 49 and 50% of GDP. But this year, we are expecting a significant increase in the debt burden, something that can go, depending on your assumptions, to 65, 66% of GDP. And over there in the bars, what you have is the decomposition, and all the variables are playing against us. Growth contracted, so our I minus G is turning into negative, from positive data dynamics to negative data dynamics. Our currency is selling off at the beginning, and that depreciation is hitting our debt burden. But what we want to convey to markets is that we're not comfortable with this debt burden level. It actually crosses a parametric limit that we have of 60% of GDP, similar to the Maastricht principles. And once this pandemic ends, what we need to do is to embark in a fiscal consolidation strategy that actually get back this debt burden to the levels that we have before that. Finally, in terms of the anchors for macroeconomic stability, I will tell you that the main differentiator across emerging markets, the moment the pandemic abates, is this issue of the capacity of the political system and the democratic institutions to deliver incremental reforms. And in that, Colombia has both a favorable track record and good perspectives. In the terms of the track record, you'll see on the left that we have all the economic bills that we have tabled to Congress over the last 22 months. And we're happy to report that all these bills, the 6 bills that we have sent, have been passing with a favorable majority of 2/3, both in the plenary of the House and the plenary of the Senate. In addition, after a tactical cabinet reshuffle that the president undertook in February before the pandemic, we were able to increase our government majority participation in Congress from 50% to something closer to 60%, by the virtue of incorporating this previously independent party into the government coalition. So what we're trying to say is we don't want to minimize the challenges of passing reforms in Congress, but what we want to say is that Colombia has both this track record and it has a government coalition that has been strengthened by this pandemic, and approval ratings for the president that have also been strengthened during the pandemic, thanks to its management of the emergency. In terms of economic opportunities, I want to go faster and maybe being able to have more time for Q&A, but I will point out to 3 main areas. The first one is that our fixed income markets continue to develop, continue to be more liquid, continue to have more participants, and to continue to be more internationalized. This is only the government debt market, and you will see how Colombia is sort of in the optimal size of its local currency market for government debt. Our market is of a size of 30% of GDP, very aligned with the levels of other markets like Mexico, Thailand, and India, but far better in terms of size and liquidity compared to Turkey, Indonesia, and Russia. But of course, we don't want to be in that territory of Hungary, South Africa, and Brazil, because that really means that debt starts from being a virtue to be more of a problem. We have two products to offer. We have a very liquid curve in fixed rate, which you see on the left. You will see there benchmarks that are very homogeneous, of around, I would say, $8 billion, the equivalent of $8 billion. And on the right, we have a market that is less homogeneous, but that we're working on providing greater liquidity and a more standardized path of benchmarks, and is our inflation linkers curve. Colombia has a feature that not many emerging markets have, and is the fact that we don't have a dominant player in the market. We have a very diversified holders structure. Our pension funds hold 30% of our bonds. The foreign funds investing in Colombia, 23%, commercial banks, 17%, public sector financial institutions, 14%. And what this has provided is greater liquidity, and if you ask around, and we have discussed in previous forums like this, is the fact that it is very easy to get into the Colombian market, and it is also very easy to get out of the Colombian market, depending on the view of the market that you have. And we also have a very diversified structure across regions. I want to point out only to continental Europe. Continental Europe has become the largest holder as a region of our local currency bonds. You will see that in the last 2 years, the holdings have been increasing from 40% to almost 46%. And this has a lot to do with our full accession to the OECD that we finished over the last 2 years. Over here, we have a very nice chart showing you the returns on our local currency curve. This is, of course, unhedged, and you will see that from the low tenors to the middle part of the curve, they have been positive and in double digits. And obviously, by the fact of the steepening of the curve, the return has been more modest in the longer part. But encouragingly, we have had more and more issuers emerging in our market. We have securitizations like these, we have corporates like these, we have banks, and we have also, for example, subnationals like these that are increasingly issuing bonds, are tenors that are between 5 and 20 years. And they offer interesting pickups against the sovereign. The second thing that I want to highlight is that Colombia remains a very attractive foreign direct investment destinations. This is the data from the balance of payments up to 2019. And you will see 3 things here. The first one is that FDI grew by 26% nominal. That means $3.5 billion in additional FDI last year. The second factor that I want to highlight is that non-oil FDI grew at twice the pace as oil FDI. And this is important because of the diversification argument that we want to make. And you will see in the lower part of the chart that the sectors that have benefited from these inflows are really varied. Yes, oil remains important, 20%, but is as important as finance and retail and manufacture and transportation. And when you annualize the FDI that we receive as a percentage of GDP in 2019, not only we outperform other emerging markets in the triple B category, like India, Mexico, but we also reach a level that allowed us to be very comfortable in funding the whole current account deficit through foreign direct investment. Now, a good question is, how is FDI performing after COVID? And the information that we have from the first quarter, from the balance of payments again, is that the trends continue. So actually, FDI grew 6%, even despite the hit from the COVID in the first quarter. But you will see that we have reported more aggressive growth of non-mining FDI that actually more than offset the deceleration or the contraction in oil FDI. And this is important, and we only highlight here two sectors that have been very dynamic. Utilities is a sector that is developing very well in Colombia, in the electricity, in the gas, in the water, and also things like, for example, health, education. These type of services have also been accelerating. This is a chart that I like to show because when you talk about these main aggregates in macroeconomics, it's difficult to see, but who is investing in Colombia? And what I try to summarize here is sort of the landmark transactions that we have had in the last 18 months. And you will see the first one is SoftBank investing in Rappi. I'm pretty sure the Latins that are connected know what Rappi is, but it's basically a delivery service, very popular these days during the pandemic. It's a Colombian unicorn, and it's an investment of nearly $1 billion from a Japanese company. The third one is very interesting, is United Health, which is investing in some health chain here in Colombia. And you see there other examples that I don't have time to go over them, but are important. The last point that I want to make is infrastructure. Colombia, and this is the Infrascope ranking from the Intelligence Economies Unit that ranks nearly 24 of countries in Latin America and the Caribbean, and Colombia ranks number 1 in 2017 and then number 2 in 2019. And basically what it's telling you there is that we have probably the most solid legal framework for infrastructure and the second most sophisticated system for attracting capital and developed markets. And I promise this is the last slide, but what you're seeing there is we used to have a pipeline of 30 projects in infrastructure, mainly toll roads. From those, we have financial closings for 21. So there's still 7 more billions to close. That's the primary market for infrastructure. But we also have a secondary market for infrastructure in which the constructors are starting to offload now that the construction risk is abating, and we're having this new generation of sponsors coming to buy those stakes. And that secondary market for infrastructure measures something like $5 billion, 1.5% of GDP. And we're also launching, previous to the COVID and now with more force, what we call the 5th generation in infrastructure, which has two particular features. One, it has a decent size, it's a $5 billion. And two, we're moving from toll roads only to a multimodal infrastructure in which we have roads, we have airports, we have river navigation, and we have railroads to develop. So I'm gonna stop there. Apologies for the slide over time, but I'm happy to respond to any other questions that you have.
That was excellent, Cesar. Thank you very much. And it was great to see the resilience in the economy, as well as your diversification across your funding mix there. I'm just taking a look at some of the people that have logged on to view your session. I think one thing that might be interesting if you had a minute or so is just what are you looking for from the bankers that you're working with at the moment in terms of your criteria, whether that's a a local currency or a hard currency transaction. You know, what do you look for from your banking partners there? And has any of that criteria changed in a post-COVID world?
Yes, thank you, Avin. What I will tell you is that we will continue to apply the diversification strategy. When we previous to COVID, we had a budget deficit of 2.2% of GDP. It was, being humble, relatively easy to finance.
Yes.
And in the first part of this emergency, we increased the budget deficit target to 6.1% of GDP. And that required from us to be very active in different areas. One, continue our efforts to develop the domestic market as much as we can fund in local currency and at long terms. We will do it. We have been very public about our goal to increase our duration of our domestic fixed income curve from 15 years, which is the maximum tenor now, to 30 years. And we're seeing a positive backdrop these days to do that, despite the slight steepening of the curve. But we also had to be very active in multilaterals. We basically doubled our envelope for multilateral financing with more than 6 counterparts. And as you saw 3 weeks ago, we also had an important issuance in international markets for $2.5 billion. So what are we going to do next? I think that 6.1% of GDP, to be quite honest, it seems more like a floor rather than a ceiling.
Okay.
The probability that that will be lower in this emergency is very low. The probability that it will be higher is higher. How much higher is a question mark. You monitor this very closely. But we have other lines of defense. I think that our local domestic market has performed very well, and we will continue to rely on there for funding. But we also have, for example, if things really get complicated, we have access to a financing facility with the IMF that also enjoys Peru and Chile for up to $11 billion that we can explore in case is needed.